Final tax on passive income. For better understanding of final tax and passive income, final tax is one of the exemptions to the scope of regular income tax. An excellent understanding of items of passive income in those taxpayers subject to final tax, including their final tax rate, is extremely crucial in mastery of income taxation. Passive income. Items of passive income are earned with very minimal involvement from taxpayer and are generally irregular in timing and amount. General rule: all passive incomes are generally taxable. Passive income earned within the Philippines are subject to final withholding tax unless exempted by the law. Passive income earned outside of the Philippines are not subject to final withholding tax, but such are added to gross income as non-operating income.
Final withholding tax on passive incomes derived from the sources of the Philippines. Final withholding tax is a kind of tax which prescribed on certain income payments and is not creditable against income tax due on the pay on other income subject to regular rate of tax for the taxable year. Final withholding tax includes: first is interest, next is dividend income, and the last one is royalty income. First on the list is interest income, which includes deposit substitute, trust fund, mutual fund, and other similar arrangement with the corresponding rates of 20% on domestic corporation, 20% on resident foreign corporation, and 30% with the non-resident foreign corporation. Next is royalty income. Royalties received by domestic or resident foreign corporation from a domestic corporation are subject to final tax of 20% and 30% on the non-resident foreign corporation. The last on the list is cash or property dividend. Domestic and resident foreign corporation are exempted or not subject to tax, while a non-resident foreign corporation rates 15% with tax sparing if the country in which the corporation is domiciled or a residence of the NRFC, and 30% without tax sparing.
Here is the summarized table of certain passive income derived from Philippine sources subject to final tax. Interest in any currency bank deposit, yield monetary benefit from deposit substitute, yield monetary benefit from trust fund, and other similar arrangement. Royalties. The corresponding rates of DC and RFC is 20%, while NRFC is 30%. Interest income derived from depositary bank under expanded foreign currency deposit system. The corresponding rate of DC is 15%, RFC is 7.5%, while NRFC is exempt. Intercorporate dividends received from domestic corporation received by. The corresponding rate of DC and RFC is exempt, while NRFC is 15% and 30%.
So for our example, looking at the illustration, Chen Corporation provides the following data during 2018 taxable year. Their gross income is from sale of merchandise, rent income, and miscellaneous income. Next is operating expenses. Interest income from savings deposit, from government bonds, from foreign currency deposit unit or FCDU bank deposit, dividend income from domestic corporation, and from foreign corporation. Earlier, they discussed about the corresponding tax rates under domestic corporation, resident foreign corporation, and non-resident foreign corporation. So, in a domestic corporation, assuming that Chen's corporation will determine the final taxes on passive income, we just have to multiply the amount to its corresponding rate. For example, based on our illustration, interest income from savings deposit is taxable with a 20% rate, so 100,000 pesos multiplied to 20% is 20,000. Next, interest income from government bond is 100,000 pesos multiplied to 20% it will be 20,000. Last is interest income from foreign currency deposit unit or FCDU bank deposit is 150,000 pesos multiplied to 15% is 22,500 pesos. So moving on, when you will find the final tax on passive income, you just have to add the passive income that you will get. Note that the dividend is not subject to tax when it received from domestic and resident foreign corporations.
So now let's move on to resident foreign corporations or RFC. Please take note that the taxable passive income for RFC are only those that are acquired within the Philippines. So for the tax rates, it is treated the same manner as DC, so they have the same tax rates except for interest income derived from depositary bank under expanded foreign currency deposit system, because for a domestic corporation, it is taxed for 15%, but for a resident foreign corporation, it's only half of it, which is 7.5%. So we're gonna use the same sample illustration. Let us consider that Chen Corporation is a resident foreign corporation. Let's first identify what are the passive income. So there are three: interest income from savings deposit within the Philippines, interest income from government bonds, and interest income from FCDU bank deposit. So here is the computation. For interest income from savings deposit within the Philippines, it is 100,000 multiplied by its tax rate of 20%, you will get 20,000 pesos. For interest income from government bonds, it is 100,000 multiplied by its tax rate of 20%, you will get 20,000 pesos. And for the interest income from FCDU or foreign currency deposit unit bank deposit, it is 150,000 multiplied by its tax rate of 7.5%, you will get 11,250. And to get the total final tax on passive income, you just have to add all of this. And for these three, you will get 51,250 pesos. So that's your total final tax on passive income for a resident foreign corporation. And if you're wondering why dividend is not included in the computation even though it is classified as a passive income, it's because dividend income received by a resident foreign corporation from a domestic corporation is not subject to tax.
So now let's move on to the last example, which is about non-resident foreign corporation or NRFC. Here, the tax rates for NRFC are different from DC and RFC because all passive income of a non-resident foreign corporation are taxed at 30%. But for the interest income derived from depository bank under expanded foreign currency deposit system, it is exempt. However, if DC and RFC are exempted for the dividends, NRFC is taxed at 15% or 30%. So for the example, we are going to use the same illustration. So here we have three passive income, which are interest income from savings deposit within the Philippines, interest income from government bonds, and dividend income from a domestic corporation. So for the computation, interest income from savings deposit within Philippines, which is 100,000, times the tax rate, which is 30%, total of 30,000. Next is the interest income from government bonds, which is 100,000, times the tax rate, which is 30%, the total of 30,000. Next is the dividend income from a domestic corporation, which is 125,000, times 15% So here we use 15% for the tax rate because it is under sparing rule. So total of 18,750. You just have add all the three and the total final tax on passive income is 78,750.